Hey, what's going on, everybody? We are live with Financial Fitness Friday. And what we are going to be talking about is in challenging times, banks cut credit limits, right? I saw this a lot in like 2007, 2008 when I first started. And, one of the biggest parts of this is like there's no advanced warning, all right? So you could be waking up, going to bed with $100,000 Amex card and a $250,000 line of credit, and you wake up and you get a notification that, hey, they just cut your card, to 25,000 and your line of credit to 100,000. And here's the other part of what this does. It really does mess up your scoring ratios. Because let's say you had a $20,000 balance on a $100,000 card, you only have 20% utilization. Now you have a $20,000 balance on a $25,000 card, and you're at like 80% utilization. And the problem with that is it's going to drop your credit score. And then that is going to have further negative impacts. It's going to it's going to hold you back from getting additional financing or getting into the best types of loans, right? And you see this constantly. Amex does it a lot. All the major cards do it. The banks do it. And it's always when there's certain uncertainty in the market or when there's fluctuation. So, how do you prevent that from happening to you? Well, the first thing is I would say keep your credit up. Dave, you want to jump in there?
Yeah, man. I always come in with a couple of key takeaways or key things for people to do. And guys, let me go back to what Jonathan was saying, because there's a misnomer on here that he touched on something very big. There's a misnomer that, hey, if you've been with a bank or an institution or had an account with them for 10, 15, 20 years, that all of a sudden you have some type of quote unquote friendly business relationship. And guys, that's not true, man. A lot of these bigger, actually, not a lot, pretty much all of them, all these big banks, you're just a cog in the wheel, right? You're just a number in their system. Like if you don't look good in their quarterly, semi-annually, annually underwriting, that they do, because they will do it, they do soft credit checks, they take a look at you, then they're going to cut it. You're a risk to them, okay, based on that data, good, bad, or indifferent. Okay, it's a risk assessment, so they are going to cut it. So guys, couple things. Number one, obviously know where you stand, and as silly as it sounds, just pull your report. I can't, and the reason I say this is even so many people in business have no idea where they stand. It's almost like set it and forget it. Okay, well, what is it? Well, I haven't looked at it in a while. I have no idea. Oh, I have this late payment here. Oh, gee, I didn't know that. That's supposed to be this or that. And the next thing, oh, I have this account. I don't remember getting that. And it repetitively happens all the time. And I
Yeah.
laugh about it because I hear it daily almost. And it's crazy because that's your lifeline for scaling, right? For either scaling or when you need something right away or when you're in a jam. And if you have no idea where you stand, that's a problem in and of itself. So that's the first thing. So then number one. Number two, what do your revolving trade lines look like? That is the foundation for your credit score. Okay. If you are anywhere above 30 to 40% cumulatively, get that down as soon as possible. Don't go over that. That's when you kind of start to raise red flags. You get over 40%, and this is just an opinion of mine. I've noticed this with trends and speaking to people that this has happened to. Okay, you're going to raise a red flag. You're going to start getting pulled. You're going to get looked at. Oh, okay, they're above 40%. It's a little risky. We're just going to cut it. They cut it first and then notify you, usually a week or two later.
Mhm.
So that's that collectively. Now look at it on an individual basis. Where do your cards stand individually? Do I have one here? Maybe that's 20%. Okay, but I have one over here that's 70. 70, that's a little problematic, but that 70 doesn't have to be that high. Okay, you could have $1,000 credit limit, have a $700 balance, and you're like, I only owe $700. That's a
Mhm.
drop in the bucket. I'm not going to worry about it. That's when the worst things happen right there. It's all about the percentage and not what you owe. And just from slipping for something you think because it's $700, that doesn't mean a big deal. That's the bigger deal, because of that percentage. So look at these things. Now, two things with that, knowing where your percentage of utilization, if you can get that stuff paid down or paid off as soon as possible, or if not, as long as your scoring and other metrics pan out, I always suggest roll that into some type of debt loan if possible, as soon as possible, to clear that up, to get it off those revolving trade lines. That'll actually help you more in the long run than keeping that stuff on the revolving trade lines.
It's cheaper too.
Right. And the main problem really, it is revolving trade lines, because financial institutions, okay, well, you have an installment loan. Well, that's for a set time, for a set payment, set interest rate. We know that, right? Same thing if you have mortgages. Same thing if you have an auto loan. It's the revolving trade lines, man, that can kill a credit report in an instant. Doesn't matter if you pay that stuff on time or not, right? Like if you're overextended or over leveraged, that's where the red flags come from.
And guys, they look at it and they'll look at like how long it's been like that, right? So if you have a card that you're not paying down to zero and it's staying at 50, 60, 70% utilization, eventually that's going to catch up with you. Make sure you're doing big chunks. And if you want to know how to do it, just use the waterfall method, right? And the waterfall method says, hey, any extra disposable income I have, I'm going to use it to pay off the card with the highest interest rate. Get that thing paid off and then repeat the process for the next highest card, right? And that will keep you guys in good standing and having that access to credit and financing when you need it. Because the worst thing you could do, okay, is have bad credit and then go need to borrow money. Right? I say it all the time with business lending. The best time to apply is when you don't need it, because you're going to score out higher and you're going to get better terms, right? And then just use it responsibly. That is a big deal, guys. And I think one of the worst things you could do is start a business with bad credit, because then you are basically bootstrapping it until that credit is fixed. And if you've ever ran a business or owned a business, hey, there's feast and famine, there's ups and downs, right? And so that first year, that first 2 years is typically not that smooth, right? And so it's going to be harder to fix your credit while you're trying to build a business. And so that's why I tell you, if you're going to start a business, start it with the best credit possible. And keep these things in mind that we said, because you could be a 7 or 8 figure business owner. This stuff still applies to you.
Mm-hmm. Yeah, man. The crazy thing is, man, we had probably 3 or 4 years ago, and I'm not going to mention who he is, but a very well known business owner in Philly, who I think he is like a $200 million business, and same thing, never really looked at his credit. He had the ability to buy things in cash all the time until he wanted to buy, a shore property, and, he wanted to put 25 or 30% down. And now he needed 60% down because of his credit being bad. And when you're talking millions of down money, that's a big sting to go from 20 or 2.5 million to 6 or 6.5 million. That's a big spread. Okay. So think of that. Could he do it? Yeah, but he wasn't happy about it. And then until you say, hey, man, well, you have this wrong, you have that wrong, and you have this wrong. Like, tell me about it. Oh, well, my assistant was supposed to do this. Oh, well, paid it later or whatever. And it's like, listen, man, we don't care if you're worth 200. The banks don't care if you're worth $200 million, dude. They want to be paid back on time. You know what I mean? They don't want to chase you. They don't want to put this stuff in collections. They don't want to charge it off. Okay. They're going to win. Okay. You have to understand that. Like, they don't, just like the casinos, man. The house always wins, dude. They don't lose. And it doesn't matter what your net worth is. They're going to come out on top. Just some quick statistics. This is actually from the New York Federal Reserve Bank. End of Q5, right? Because we're already in the second Q, but this is when the most recent data was updated. Credit card balances are at 1.82 or $1.28 trillion. It's almost hitting 1.3. It's up 44 billion from the previous quarter, from Q3 of 2025,
which was an all-time high.
Yeah. So, and it's still rising, guys.
Yeah.
So that, oh, well, you might sit here and say, oh, well, it doesn't affect me. I'm in good standing. You don't know that, and I always go back to COVID, man. When FHAs, right? Like when COVID first happened, when especially the Pennsylvania market got weird, Dude, we were getting people approved for FHAs all day long. That was my specialty from 2016 until 2021, getting people approved for FHAs because of the barrier of entry. Well, that 620 now went to 700 for an FHA that's backed by private mortgage insurance to where you don't need down. Now the barrier of entry to get in that was next to near impossible for most people, right? So don't think it can't affect you either, good standing or not.
Yep. All right, guys. Well, look, you heard it here. Share the show with someone that needs to hear it. We appreciate you guys for tuning in, and we'll catch you on Mindset Monday. Take care, guys.
Be great, y'all.